Hi, and welcome to this week's market presentation. Latest news. Starting with the latest news, we begin in Venezuela, where on January 3rd, the U.S. conducted military operations in Venezuela that led to the capture and extradition of Nicolas Maduro and his wife. Maduro, who is now in U.S. custody in New York, is said to be indicted on charges of narco-terrorism, among others. Venezuelan Vice President Delcy Rodriguez has assumed the acting presidency. Overall, there's a lot of uncertainty on the situation, particularly what is going to happen next regarding the government in Venezuela and what that will mean for U.S.-Venezuelan relations. Following the extradition of Nicolas Maduro, President Trump announced that the U.S. would, quote, be running Venezuela until a transition takes place, although again, it remains quite unclear what that will entail in practice. Overall, while this was significant geopolitical news, the impact on energy and financial markets is expected to be limited. So far, Venezuelan oil exports have no longer represented such a large share of global demand. And when it comes to increasing export activity, significant investments would have to be made. Nonetheless, as we get more information regarding what the government of Venezuela will be moving forward and how that will impact the relations with the U.S., we'll see a clearer picture of what this will mean for global energy markets. Over in Europe, Russia rejected the U.S.-led 20-point peace plan as talks between Russia and Ukraine collapsed following accusations from the Kremlin of an Ukrainian drone attack targeting Putin's residence. While the Ukrainian and U.S. intelligence agencies deny that such an attack took place, peace talks have nonetheless taken a turn for the worse. The impact on markets has similarly been limited, in part because of the already lack of optimism regarding a swift end to the war and an end to the ongoing sanctions against Russia. This will certainly increase expectations of a longer conflict between the two countries. It will remain to be seen what the position of the U.S. government will be and whether they will begin pressuring Russia through more aggressive means or if they will continue to pressure Ukraine to a larger degree to come to the negotiating table. And then lastly, moving on to the Middle East, the situation in Yemen has deteriorated as well as Saudi Arabia launched airstrikes against the UAE-backed STC separatists in Yemen. The STC control of oil goes against Saudi Arabia's interest in the region, although again, due to the limited volumes that have been impacted so far, the impact remains more limited. Nonetheless, this is certainly going to raise tensions within members of OPEC+, which could see its cohesion tested in the coming months at a particularly tense moment given the oversupplied expectations for crude oil markets globally and the relatively low oil prices that we are seeing at the moment. Weather. Moving on to the latest weather forecast in Europe. Here we note colder weather forecasted over the beginning of this week, which is then expected to ease down at least over Southern and Western Europe. Northern Europe, on the other hand, is expected to see well below average temperatures for the duration over the next 7 to 10 days. At the same time, precipitation is expected to pick up across most of Europe, with most European countries expected to see precipitation over the coming week. Over in terms of average wind speeds, we see a similar uptick in average wind speeds, particularly through the middle and beginning of the following week. Macroeconomics. On the macroeconomic front, we've seen newly released manufacturing and service PMI figures for the month of December. On the manufacturing side of things, for the euro area, we saw a slight deterioration in the PMIs from just under 50 points to now just under 49 points for the month of December. The US saw a similar slight decrease there, down 0.4 points month over month. On the other hand, when we look at China, there we see a more stable to positive picture with the overall manufacturing and service sector PMIs according to the National Bureau of Statistics having increased over the past month. crude oil and LPG. In terms of crude oil prices globally, here we know relatively stable prices over the past week, but nonetheless, we continue to see oil prices at near the lowest levels we've seen in quite some time. Oil prices on WTI continue to creep closer to $55 a barrel, while prices for Brent are getting close to falling below $60 a barrel once again. The latest monthly report from the Energy Information Agency in the US shows a relatively static picture month over month, with not much change in terms of supply and demand expectations for the coming year. Overall, as you can see in the bottom graph, expectations remain for a significantly oversupplied crude oil market moving forward. Natural gas. Natural gas prices in Europe saw a slight uptick over the past week. The increase was more pronounced in the second quarter of this year, moving up 2.5% on the week and 4% month over month. Overall, looking now at the frontier of 2027, we see just a slight upward movement of 1.3% on the week and an overall neutral price evolution when we look back at the past few weeks. Overall, natural gas prices in Europe do remain on the lower end than what we've seen over the last year and a half. Gas storage levels in Europe open at the lowest levels in over 3 years, with storage levels nearly 10% lower than the previous year and near the lowest levels since at least 2012. Withdrawals from storage at the end of last year were near record highs, significantly below the past 13-year average. Given the colder weather forecasted over the next few days, we expect for withdrawals to remain very strong over that period of time, hopefully easing off as the warmer weather arrives, particularly at the beginning of next week. So you can see on the right-hand side, total demand increased significantly over the last week of December, pushing up near to the highest levels over the past 5 years. At the same time, total supply remained relatively stable at the bottom of the range over the same time frame and started off this year in line with last year's levels. The European gas supply mix continues to be dominated by Norwegian gas flows and LNG sendouts. Norwegian gas flows saw a slight downturn over the last week of the year, but remained relatively in line with the past 5-year average. LNG sendouts, on the other hand, remain near the top of the range over the past 5 years, in part on the back of record levels of LNG imports into Europe, which remain near the highest levels over the past 5 years for this time of year. That has certainly been aided by the record levels of global LNG exports as well. Overall, investment fund positions have remained relatively stable over the last few weeks, although we are starting to see a slight decrease in the level of short positions in the market as the level of net long positions remains still in short territory. Coal. Looking at coal prices globally, we see a slight decrease in the price level, particularly when we look at coal prices in the API2 and API4 index. Overall, we do note limited demand in Europe for coal, given the lower gas prices that we're seeing in the market and the high carbon allowance prices, reducing any gas to coal switching and incentivizing coal to gas switching. Over in Asia, we do see Indonesia considering reducing global exports as international demand has remained weaker than anticipated, and that has been in part driven by the lower demand of China for new imports given the robust domestic production levels. EU and UK emission allowances. In terms of emission allowances, we see a relatively stable evolution when it comes to the European market with limited movement over the past week, while UK allowances have moved further up 2.3% on the week and nearly 18% over the past month. Power sector emissions in Europe ended last year within the range over the past 5-year average and have started this year along the same lines. Nonetheless, the improved renewable energy output throughout 2025 and the reduction in coal-fired power generation certainly easing off overall power sector emissions. Investment funds continue to have a bullish sentiment regarding carbon allowance pricing, with the level of net long positions at a new record high in Europe and near record highs in the UK. Overall, market expectations are still for tighter supply and demand conditions throughout this year, adding to the bullish sentiment amongst investment funds. Electricity. Moving on to electricity prices here, we note the limit of movement when we look at the forward curves for the forward years, with limited movement week over week. Nonetheless, in line with the uptick that we saw in the second quarter for natural gas prices, up around 2.4%, electricity prices in the German power market are up nearly 3.4% on the week and just over 6.5 percentage points over the past month. Looking at the price evolution across other European markets, other than in France and the Iberian Peninsula, we are seeing a slight upturn when it comes to electricity prices for the front year. Over in the Nordics, we've similarly seen a slight increase there across the region. Looking at total demand for electricity across Europe, we know total demand having increased over the past week of last year, driven by the colder weather the region was experiencing, and that has continued through the beginning of this year. Looking at the supply mix next, we note the very good performance of nuclear power generation, particularly in France, one of the main drivers of the downward pressure that we see in French power prices, as nuclear power output in Europe moved to the highest levels over the last few years. Renewable power generation, on the other hand, was somewhat more subdued than what we've seen over the last 5 years, just below the high levels we saw in 2023, but still above the past 5-year average. On the other hand, when we look at fossil power generation, there we see output near the past 5-year average. In terms of renewables, we are seeing better levels of wind and solar power generation compared to previous years, or compared to the past 5-year average. While on the other hand, especially at the end of last year, we did see somewhat poor hydropower generation, reducing the overall output of renewables across the continent. In terms of fossil fuels, we certainly see the higher levels of gas power generation, in part at the expense of coal, given the coal to gas switching that we've been seeing in the power sector as a result of the lower gas prices and high carbon allowance prices. Lastly, when we look at the price evolution for guarantees of origin, we see quite a bit of stability over the past week. Demand certainly could have seen increasing levels due to corporate year-end buying, and as a complete 2025 needs became clear. Nonetheless, we still see guarantees of origin prices across Europe coming in near the lowest levels we've seen over the last year and a half. Part of the reason has certainly been the improvement in the cumulative renewable power generation in AIB countries, which ended 2025 very much in line with the record highs we saw in 2024, narrowing the gap that we saw starting to increase during the summer months. Overall, solar power generation has seen record levels of output over the past year, with wind power generation in line with the levels in 2023, just below the levels that we saw in 2024. Hydropower output certainly the biggest disappointment, to put it that way, with output coming in notably below the levels that we saw the previous year. That covers this market presentation. Thank you for joining.